Welcome back to the European Open. We are 41 minutes into the trading day and looking at kind of a mixed picture here with the FTSE rising just 0.1% as the DAX falls about a quarter. Rio Tinto CEO Jean-Sébastien Jacques is stepping down after an explosion to open a mining area destroyed a 46,000-year-old Aboriginal site. That comes amid mounting pressure from investors for the mining giant to step up its response. Marsha Langton from the University of Melbourne said Rio's corporate culture needs an overhaul.
That will give the company room to now do what is the most important course that they should take, and that is to find the right person to rebuild the internal culture of the company so that the company does not continue to destroy important Aboriginal sacred sites and treat traditional owners, Aboriginal traditional owners, and Australians in general with the contempt that Jean-Sébastien Jacques and Simone Niven have.
For more, let's bring in Bloomberg Daybreak anchor Anne-Marie Hordern and commodity enthusiast. Anne-Marie, walk us through what happened here, because JSJ just had, 2 weeks ago, support from the board to stay.
Yeah, that's right. But clearly the investor pressure was mounting, and they didn't like the way the board had originally dealt with the matter. And it's not just the CEO that's going. It's the head of the iron ore department as well, and the head of corporate relations. So really, it's a big shakeup at Rio Tinto. And this all stems from what happened earlier in the year. And this was a blast that was near the Australian Aboriginal sites in Australia, and investors really criticized how they had originally dealt with that situation. So this is the backlash of that destruction. It was rock shelters. They were used by Aboriginal Australians for cooking and shelter as long as 4,000 years ago. But really the big takeaway is that ESG, environment, social, governance, this is just not nice to haves anymore. As part of corporations, investors really care about it, and you can see given the amount of pressure they placed on Rio Tinto.
Anne-Marie, thanks very much for the update. Bloomberg's Anne-Marie Hordern with the latest on Rio Tinto. Let's get a Bloomberg Business Flash, some of the big corporate stories that we're tracking here at Bloomberg. Here's Laura Wright.
Thanks, Anna. President Trump says he won't extend his deadline for ByteDance to sell TikTok's U.S. operations. He told reporters the app would be banned if a deal is not agreed by September 15th. Separately, sources say ByteDance is looking to make Singapore its beachhead for the rest of Asia, spending billions of dollars and creating hundreds of jobs in the state. JP Morgan is requiring most of its senior sales and trading employees to return to the office by September 21st. A source says the order applies to managing directors and executive directors who oversee subordinates, but those with childcare or health issues are exempt. It's the strongest move yet by a US bank to restaff its workplaces. Volkswagen MAN truckmaker plans to cut as many as 9,500 jobs, almost a quarter of its workforce. The company could also close 3 factories in a bid to improve earnings. Increasing MAN's profit margin is key for its parent Traton, so the division can finance investments in new technologies like electric trucks. That's your Bloomberg Business Flash. Matt, Anna.
All right, Laura, thanks very much. Laura right there in London. With your news. Up next, we're going to be talking about what happens when you're caught between stimulus and the virus pain. European stocks have been trapped in a tight range since June. Is there anything that can break the impasse between the bulls and the bears? This is Bloomberg.
the moment, we hope that the virus isn't spreading too heavily again, and that we can reach a little bit a better situation than was prospected in spring. We estimate the GDP downfall in Austria for approximately 6.8% for the whole year 2020. And if there's the perspective of a vaccine for next year, I hope that will be a sharp rise in GDP next year.
And does the virus affect your deficit and debt target estimates?
Well, it definitely affects the deficit. Without the coronavirus, the Austrian public debt would have dropped to approximately 69% of GDP this year, coming from 85% in 2015. So we did quite a good job in lowering the debt ratio. But now it's going to increase to something between 80 and 90% in the next 2 years. But on a long-term perspective, we are convinced that we can lower the debt ratio again.
And how are you dealing with the budget? And if you are planning reform for companies, we heard about a structural reform that should change the chance for the shareholder to enter in even in companies. So getting off some old shareholders like family business or foundations. Is this reform going on?
Well, what we tried to do, of course, is first of all, the priority was to save human lives. This was the reason why we did the lockdown. And of course, this had severe effects on the Austrian economies, on small and medium enterprises and so on. So we implemented subsidies for the Austrian businesses in a very large extent. Altogether, we are going to spend 50 billion euros, which amounts to approximately 13.5% of Austrian GDP, which is one of the largest packages within the European Union. And now we have to make sure that this money also reaches the companies. And at the moment, there are some conflicts with the European Commission because they don't agree on what we try to do to help our companies. They say it's not within the framework for competitiveness. But from my point of view, we have a crisis. Austrian taxpayers invest a lot of money, spend a lot of money because we show solidarity with Italy, Spain and France, and vice versa. We would like to be able to support our own businesses with our own taxpayers' money.
How many companies will have liquidity problems in 2001 and in which sector, as you talked about?
Well, the Austrian tourism branch is quite severely hit. Tourism accounts for a large amount for the Austrian GDP. It's mainly run by small and medium businesses, by family-owned businesses. For the moment, there are no bankruptcies because we gave the opportunity for tax deferrals, but we'll see how this will catch up next year. Therefore, it's even more necessary that we subsidize those companies, because those companies that had no problems before the coronavirus, we have to save them for after the crisis.
And I didn't say it before, but one question was on banks. In Austria, you have a kind of wild card case bank. The Commercial Metresburg was not a huge, but something a scandal, was a fraud. How are you dealing with that? And how do you want that this don't not repeat again?
Mm-hmm. Well, first of all, the Commercial Bank scandal was a corruption case, a crime, obviously, and it was a small regional bank. What we're trying to do now is evaluate together with the officials what we could do on a national level to prevent such a case to happen again. These investigations are ongoing.
That was the Austrian Finance Minister Gernot Blumel speaking exclusively to Bloomberg at the informal Eurogroup meeting a little bit earlier on this morning. That's been taking place in Berlin. European stocks have been trapped in a tight range then since June. Is there anything to break the impasse between the bulls and the bears? Let's talk to the Markets Live team and to the Markets Live editor, Heather Burke, who joins us now. Heather, really interesting to look at a chart very simply of what European stocks have done or have not done during this whole period of summer where we've been kind of caught up talking about US tech so much. And through all of that, Europe stays range bound. Is there anything that you can see that breaks that narrow range?
Good morning. Right now, we've got stimulus and euro area fiscal unity as a tailwind going up against an increase in infection numbers and a sputtering of economic growth. And European stocks have also been held back because they haven't had that tech momentum that the U.S. has. Right now, the biggest thing would be to see a real rebound in economic growth, vaccine hopes. Another global stock rebound would maybe be some of the biggest things that would help European stocks break out of that range.
I agree that the, seeing this chart, Heather, was fantastic in your piece because it felt to me like stocks were just going up, 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 and then over the last 2 weeks have been coming down, down. But the range has been so tight, and it made a big difference to see that. How much, what pushes this around? Is it the infection numbers? Does that make a difference to traders? Is it the stimulus? What are the key, movers on a benchmark that doesn't have these huge tech high flyers?
If you look by country, the German stocks have outperformed, and a move toward and some outperformance of cyclicals, unprecedented German stimulus has definitely helped them. If you look on the other end of the range, Spanish and UK stocks have underperformed. Spain has been really hit by travel quarantines. Its economic has lagged other euro areas, and also they've been hit by rising virus cases more than some other countries. So you have different plays, and in some cases it's a country-specific thing, but when all these factors come together, you really have European stocks in this tight range. And while it's less, while they haven't risen as much as the U.S., they haven't been as volatile either.
Heather, thanks so much. Markets Live editor Heather Burke, thank you very much for joining us. And Matt, I was just going to say that European equity markets have slipped back to the flat line, but US futures, the NASDAQ futures point higher. Maybe I should care less about that, given what we just discussed with Heather.
Yeah, absolutely. And I mean, Heather's piece says, European stocks closed the week with a small drop. I think small is the key word.
I am placing a stop on profit for Japanese yen at 106,193. Stop on profit for Japanese yen at 106,193.
Heading for a chaotic split, the European Union is giving Boris Johnson until the end of the month to back down on his controversial Brexit bill. A crack in the glass ceiling, Citigroup names Jane Fraser chief executive, making her the first woman to run a major Wall Street bank. And exits at Rio, the miners' chief executive and other senior figures are to leave amid pressure over the destruction of Australian Aboriginal heritage sites. Good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Happy Friday, everyone. It feels like a long week, but it's also the first week of September. So let's look at the markets. Let's take stock of what's been happening and what we heard from the ECB yesterday. Now, first of all, futures are climbing. European stocks are pretty much flat. We did have a mixed week overall. There have been concerns over valuations in some pockets of the market that whipsawed global equities. I'm thinking especially of technology stocks. And then the other big question, of course, is what happens to euro. On Thursday, Christine Lagarde, the president of the ECB, spurred a rally in the euro when she delivered relatively mild comments on the currency surge. And then pound headed for the biggest weekly drop since March as Brexit talks frayed. Now let's get straight to the Bloomberg First Word News. Here in London is Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Europe has overtaken the US in terms of coronavirus infections. The EU, Norway, Iceland and Liechtenstein reported more than 27,000 cases on Wednesday, compared to just over 26,000 in the US. The region has re-emerged as a global hotspot after bringing the pandemic under control earlier in the year, with resurgent infections in countries including both Spain and France. The odds of another round of U.S. fiscal stimulus have dropped. Senators blocked a Republican proposal for slimmed-down support in the region of $500 to $700 billion. Democrats are looking for $2.2 trillion. Minority Leader Chuck Schumer told reporters he hoped the result would prompt GOP lawmakers to come back to the negotiating table. The UK economy surged in July. GDP rose 6.6% from June as coronavirus restrictions were eased. Britain has clawed back little more than half of the output lost during the lockdown, but a triple threat of mounting job losses, rising virus cases, and the risk of a messy Brexit mean recovering the rest may prove difficult. And England's football teams take to the field this weekend for the start of the Premier League, but it's unclear when spectators will be allowed back. CEO Richard Masters says he hopes there'll be a small number by at least October, but without fans, he sees the world's richest football competition taking a hit of about £700 million. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
I am moving further. Stop and profit for Japanese yen to 106.203. Okay? Stop and profit move to 106.203.
It's up to the British government to re-establish trust between the two sides.
Well, indeed, the bill was very seriously damaging trust between UK and the EU. And so what we are stressing now is that it's up to the British government to work to re-establish this trust. And time is running because our assessment is that either we reach this agreement within 1 month from now. You know that the formal deadline is the end of the year, but to have an agreement, we need to have a decision taken at the beginning of next month, beginning of October. So the re-establishing of trust, which means the changes in this bill that was introduced in recent days, is of essence, and it's very urgent.
If the UK does not back down, will there be a hard Brexit?
Well, as we always said, this is not the European proposal. This is not the European will. This is not the solution that we envisage. But you need two parts to have a deal. So if there is not any seriousness in respecting the agreement that we're on the basis of the negotiation that is now going on, I think things will get very difficult among the EU and UK. We are not working for this, not at all. We are not working for a hard Brexit, but we need to have a trustful partner to have a deal.
Commissioner, we heard today from the ECB that they revised upwards their 2020 forecast, but they see the stabilization of any rebound next year. What's your assessment of the European economy right now? What letter of recovery are we in?
Well, we are, in general, with a similar analysis of the one of the ECB. Our evaluation, we will have our winter forecast beginning of November. Our evaluation is that we had a rather fast recovery, especially in June and July, but perhaps according to high-frequency data and new granular data, this speed of the recovery slowed down in recent weeks, in August. So I think we still have in front of us uncertainty around the strength and the speed of recovery. And our task is to reinforce confidence in the markets, in the citizens, and in the business community. And this is what, with our recovery plans, we will try to do in the next weeks, because uncertainty is still there, and we are not sure of the speed of the recovery which is underway.
Well, that was EU Commissioner for Economy and Finance, Paolo Gentiloni, speaking exclusively to our Guy Johnson and Alex Steele. Now, joining us this morning is Andrea Iannelli. He's Fixed Income Investment Director at Fidelity International. Andrea, as always, thank you so much for joining us. I have like a million questions, but let's start with Brexit, because after the summer lull, it's kind of like back and something that we really need to focus on. What does it mean for your world? Are there opportunities in UK assets?
There are, and so first of all, the Brexit spat that we've seen re-emerging now is is part of broader issues that we're going to have between now and the end of the year. It's one of the multiple political hurdles that and risk events that we have in the calendar. Now, for UK assets, in general, fixed income assets, credit, and risky assets overall have done really, really well since the middle of March. We have started trimming down a little bit of risk around the edges. We're still positive on UK assets and UK fixed income overall, predominantly because of the very strong support that the central banks in general are providing to the market, which is in a way sort of disjoining market behavior from underlying economic fundamentals. But if you take into account what we're seeing with Brexit, as well as the fact that we are going to see unemployment rising in the UK and in developed markets more broadly as employment support schemes kind of roll off, it's likely that we're going to start seeing some bad news creeping in through the numbers, and that kind of makes us a little bit more cautious than we were early in the year.
A little bit more cautious because you haven't yet figured out, Andrea, whether this is actually a negotiating tactic or whether we'll have a world trade, WTO agreement come January?
Well, no one really knows really how that negotiation will go. So on the basis of valuations and on the basis of the likely volatility that we're going to have going forward, it's reasonable to just take some chips off the table and sort of lock in some of the good, strong performance that some of the assets in the risky asset space have had since the middle of March. Volatility is still going to be with us. And that will in itself be an opportunity to add back to those positions at perhaps better levels.
Andrea, where do you see the biggest value? We'll talk about the ECB shortly, but if you look at the fixed income space, is there something that at the moment looks like it could be a good deal?
So there's a few areas which I think are worth highlighting. In general, we are going through what is not too similar to what we've seen in Japan in the 90s. You know, central banks buying a lot of debt, government spending increasing, consumers and savers just saving more. Now, this saving needs to go somewhere. It needs to find a home. In areas like some areas of the high yield market, like European high yield, and Asian fixed income, with Asia being the sort of first in, but now first out of the COVID crisis, and some areas of emerging market debt still offer value because they're still far from the tights in terms of spread where they were before the crisis. And flows into those asset classes confirm this dynamic is at play. Clearly, valuations they're not as cheap as they were early in the year, but opportunities are still there in our view.
Thanks so much. Andrea Iannelli there from Fidelity International stays with us. Now, coming up, as New York prepares to mark the anniversary of the worst terrorist attack on American soil, we'll speak to Tom Michaud. He's chairman and chief executive officer of Keefe, Bruyette & Wood. KBW lost more than a quarter of its employees in the World Trade Center attacks in 2001.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Overall, the balance of risks to the euro area growth outlook is seen to remain on the downside. We decided to maintain our monetary policy, to maintain our accommodative monetary policy, and certainly under current circumstances, it is very likely that the full envelope of PEP will be used for the purpose of developing those policies. We do not target exchange rate. Our mandate is price stability. And clearly, to the extent that appreciation of the euro exercise negative pressure on prices, we have to monitor carefully such a matter. The strength of the recovery remains surrounded by significant uncertainty as it continues to be highly dependent on the future evolution of the pandemic and the success of containment policies.
Well, that was the ECB President Christine Lagarde at the press conference yesterday. Still with us, Andrea Iannelli from Fidelity International. Andrea, there seems to be this, belief in the market right now that maybe President Lagarde could have been a bit stronger to condemn the strength in euro, or at least how quickly it rose. Do you agree with that? How much would that have changed?
No, I think they could not ignore the fact that the euro strengthened considerably over the last few weeks and months, and it is part of what they monitor for the purpose of their own mandate of price stability and inflation. Philip Lane actually was quite a lot more vocal around the currency, and in general, a stronger currency does tighten financial conditions, does lower inflation expectations. So. They have it on the radar, and it's part of the things that will drive their decision going forward. If the euro keeps going up, chances are we're going to see an ECB that will become more and more vocal about it.
And Andrea, again, what does that mean for how the ECB is handling the crisis overall, and where you see value in European fixed income?
So the ECB, like other central banks, will remain in place as a strong actor supporting markets. What does this mean for fixed income? It means very tight ranges in government bond yields, with real yields likely to remain firmly in negative territory. And in general, that is very supportive for risky assets overall. For fixed income in particular, credit markets will be the new home for savers looking to place what is a larger and larger stock of saving to generate an income. So European fixed income, such as European investment grade credit in particular, but even more so in given valuations in the high yield space, where defaults are not really rising despite the COVID as much as we would have thought, despite the COVID crisis, are areas where we have a very strong view on at the moment.
Andrea, we did have stronger words actually on euro strength from Mr. Philip Lane, the chief economist of the European Central Bank. I mean, he actually warned that the euro's appreciation this year has dampened the inflation outlook. So do you think that they'll step up their rhetoric and actually do something about it?
Well, they're not going to do currency intervention or such, but it will just prompt them to be more and more active in terms of keeping real yields low to make a long position in the euro, if you want, more punitive from a carry perspective. As I mentioned, the strength of the currency is part of the things that they have to look at in terms of financial conditions and inflation expectations. So it will be a driver, like it has been in the past, and the ECB will continue to be even more and more active. We expect an expansion of the purchase program between now and the end of the year, and this is a cycle that is unlikely to be broken in the immediate future.
Thank you so much for all of your insight. Andrea Iannelli there, Fixed Income Investment Director at Fidelity International. Now, coming up, a crack in the glass ceiling. Jane Fraser is to become the first female chief executive of a major Wall Street bank. Details next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Let's get another one of our top stories. Citigroup has named a new chief executive. Jane Fraser will become the first female to lead a major Wall Street bank, succeeding Michael Corbat, who's retiring in February after more than 8 years in the top job. Now, for more on this new appointment, we're joined by Candace Zacharias, Bloomberg's Asia Finance and Investing Managing Editor. Candace, thank you so much for joining us. What does the appointment actually say about how far Wall Street has come on gender issues?
Hi, thanks for having me. I think it's certainly the case that Citigroup has made history with this announcement. And this is part of a creeping change that we're seeing across corporate America. 31 women already lead S&P 500 companies, so it is great news to see that a woman will be in the top job of a powerful Wall Street bank. At the same time, I have to say that her presence also emphasizes just how rare the situation remains. The finance industry in the U.S. and really in much of the world still has a long way to go to reach both gender equality and pay equity. And that's not just the case with the CEO roles, but equally about the ranks of senior management. If you look at the top groups of influential operating teams that oversee the 6 biggest U.S. banks, only JP Morgan has an even gender split. When it comes to the board, Fraser's appointment will make Citi the only bank that is evenly split by gender among S&P 500 banks. So this is, I think, certainly going to get folks asking more questions about what's next for JP Morgan or Bank of America or Morgan Stanley or any of the number of other banks.
So, Candace, what kind of experience does Fraser actually bring to the job?
She came to Citigroup after stints at Goldman Sachs and McKinsey. She's had international experience. Her star has risen very quickly since she joined Citigroup in 2004. She's had experience running the strategic team, mortgage unit, and consumer bank. And these are all areas that will take center stage as the lender faces loan defaults and the broader fallout of the coronavirus pandemic. Her old boss, Vikram Pandit, said in an email yesterday that she's demonstrated over the past decade that she can manage.
Position closed on Japanese yen at 106.203.
Candace.
Well, as I mentioned, there's obviously the fallout of the pandemic to navigate, and that's as true of Citi as it is for the banking industry anywhere in the world today. But even prior to that, and despite its immense network in both consumer and investment banking, Citi has repeatedly missed its own targets for boosting profitability, and it trails some of its biggest peers. Earlier this year, it abandoned a target for improving return on tangible common equity, a key measure of profitability, and its stock price remains less than a tenth of what it was before the 2008 crisis. So while today, I should say yesterday's news is great news, I think Fraser really has her job cut out for her.
Candace, thanks so much. Candace Zacharias there, Bloomberg's Asia Finance and Investing Managing Editor. Now, coming up, how can global capital help fund the transition to a low-carbon economy? We'll ask Marissa Drew, Chief Executive Officer of the Impact Advisory and Finance Department at Credit Suisse. That's coming up next, and this is Bloomberg.